Welcome to The Explainer. Today, we're going behind the curtain of the business world. We're going to look past the headlines and decode the story that's really hidden in the numbers. You know, how to figure out if a company is actually in good financial shape? All right, let's jump right in. So, think about it for a second. You see a company with all the buzz. You know, cool products, a celebrity CEO, but does any of that actually mean it's built to last? How do you really get past all the hype and see what's going on underneath? It's a super important question, whether you're an investor, an employee, or honestly, just curious. So how do we peek under the hood? Well, the answer is all about using the right tools. And for this, our tools are financial ratios. Seriously, think of them like a doctor's complete diagnostic kit for a business. They're the x-rays, the blood work, the stress tests, everything we need to see what's really going on inside. They take what looks like a bunch of messy numbers on a page and turn them into clear, simple, vital signs. And that's exactly what we're going to do. A full business health checkup. We're going to examine a company's vital signs, one by one, and piece them together to get a clear diagnosis of its overall health. Okay, now, I know what you might be thinking. There are dozens, literally over 70 of these ratios. But don't worry, we are not going through all of them. We're going to do a simplified checkup focusing on just 4 key tests that give us a really powerful snapshot of a company's financial health. First up, we're checking the company's pulse. This is all about the here and now. The big question is, does the company have enough cash flowing through its veins to pay its immediate bills? To figure that out, we use something called liquidity ratios. The best way to think about liquidity is, well, it's a company's financial breathing room. It's simply about having enough cash on hand, or things you can sell for cash really quickly, to take care of all the bills that are coming due in the next year. And the main vital sign here is the current ratio. The math is pretty straightforward. You take all the stuff a company owns that can be turned into cash easily, that's its current assets, and you divide it by everything it owes in the near future, its current liabilities. Now, if that number is below 1, that's a big red flag. It means it might not have enough cash to pay its bills. On the flip side, a number over 2, that suggests a really healthy, stable company. Okay, so the company can pay its bills for the next year. That's great. But what about its long-term strength? Is it built to last? Our next test is kind of like a bone density scan. We're checking for any deep structural weaknesses by looking at how much long-term risk the company is carrying. And the tools we use for this are called leverage ratios. Leverage is really just a fancy word for debt. So these ratios tell us just how much a company depends on borrowed money to operate. Now, a little bit of debt can be a good thing, right? It can help a company grow faster. But way too much, that can signal some serious risk down the road. The big one here is the debt-to-equity ratio. It's a simple comparison. How much debt does the company have versus how much money has been put in by its owners, its equity? Put it this way, it asks a really simple question. Who has a bigger claim on this company's stuff, the lenders or the owners? Generally, a lower number is a lot safer. It means the business is standing on its own 2 feet, not propped up by a mountain of borrowed cash. All right, so far our whole checkup has been pretty internal, right? Looking at the company's own books. Now it's time to get a second opinion. We're going to see how good the company is at actually making money, and maybe more importantly, how does the stock market, all those investors out there, what do they think about its value and its future? So let's talk about a key number for profitability, the gross profit margin. This basically tells you how much profit a company makes on each and every sale after you subtract the direct costs of making the thing it sells. And wow, the difference between industries can be absolutely massive. A software company, it might keep 80 cents from every dollar because, making another copy of their software costs next to nothing. But a manufacturer, they might only keep 25 cents after paying for all the metal, plastic, and factory time. And now for that market's vote. This is the price-to-earnings ratio, or PE ratio. It tells us exactly how much investors are willing to pay for every single dollar the company earns. So if you see a really high PE, which you often do in tech, it means investors are betting on huge growth in the future. A low PE? That could point to a more stable, mature company, what people call a value stock. And look, neither one is better than the other. They're just telling you 2 totally different stories. Okay, we've run our tests, we've got our numbers. But now, we've come to the most important part of any diagnosis. Because a number that looks perfectly healthy for one patient can be a sign of a critical problem in another. When it comes to this stuff, context is absolutely everything. Just look at that debt-to-equity ratio we were talking about. For a tech company, a ratio under 0.3 is fantastic. But for a bank, a ratio of over 5 is totally normal. If you saw a tech company with a debt ratio of 5, Oh man, alarm bells would be screaming. So what gives? Why the massive difference? It's all about their business models. A tech company is what we call asset light. It doesn't need massive loans for things like factories. But a bank's whole business, its entire reason for being, is built on taking customer deposits, which, yep, are technically debt, and then lending that money out. So for a bank, a high debt ratio isn't a bug, it's a feature. It's just how they work. And this whole idea of context gets even more specific. Some industries have their own little rules of thumb. Here's a great one. In the world of high-growth software companies, SaaS, investors have this thing called the Rule of 40. It's a super quick check. You just take the company's revenue growth rate, add its profit margin, and see if it's over 40%. It's this unique little yardstick they use to see if a company is balancing crazy growth with actually making money. So, what's the big takeaway here? What's the final diagnosis? It's this. No single number, not one, ever, tells you the whole story. A low current ratio might look terrifying at first, but maybe not if that same company has amazing profits and almost no debt. The real insight, the true story of a company's health, only comes into focus when you put all the clues together, when you look at all the numbers, and, this is the key, always understand the patient. So now you've got the toolkit. You can do a basic financial health checkup. You speak the language of liquidity, leverage, and profitability. So I'll leave you with this question. What story are your investments, or even just the companies you find interesting, really telling you?